Hello everyone and welcome back to another ACCA FA tutorial. Today we're going to learn about IAS 37, which is Provisions, Contingent Liabilities, and Contingent Assets. So this topic is one of the most tested areas in ACCA financial accounting because it teaches us how to deal with uncertainty. In accounting, not everything is certain. Sometimes, a company knows it may have to pay money in the future, but it doesn't know exactly how much or exactly when. Sometimes a company expects to receive money, but it isn't guaranteed yet. So the question is, should we recognize it in the financial statements? Or should we disclose it in the notes? Or should we do nothing at all? So that is exactly what IAS 37 helps us to decide. So by the end of these lessons, you will be able to define provisions, define contingent liabilities, define contingent asset, understanding disclosure requirements, and also you guys can answer ACCA exam style question with the confidence. Okay, let's begin. So first, why do we need IAS 37? Let's start with a simple example. So the example number 1, which is imagine a company sells laptop with a 1-year warranty. The companies know some customer will come back with defects and request repairs. However, the company does not know first which customer will claim, when they will claim, or how much the repairs will cost. Should the company ignore this future cost? No. Or like the example number 2. So suppose a company is being sued by a customer. The court case is still ongoing. The company may lose and pay compensation, or it may win and pay nothing. How should accountants report this situation? IAS 37 provides rules to ensure companies report these uncertainties fairly and consistently. So, what is provision? A provision is a liability of uncertain timing or amount. Notice that it is still a liability, so the company already has an obligation. The only uncertainty is how much will be paid and when it will be paid. Examples include warranty claims, environmental cleanup costs, legal settlements, and last is refund obligations. And one important point is provisions must be recognized in the financial statements if specific conditions are met. Okay, moving on. So under IAS 37, there are 3 important categories. So first is provision, second is contingent liability, third is contingent asset. The biggest challenge for students is deciding which category applies. So throughout these lessons, keep asking, is it a provision, a contingent liability, or a contingent asset? So the 3 recognition criteria, this is the most important sections of IAS 37. So to recognize a provision, all 3 conditions must be satisfied. I want you to remember this shortcut, POR. So first, condition number 1 is present obligation. So the company must have a present obligation resulting from a past event. The obligation can be legal obligation and constructive obligation. So first, let's talk about the legal obligation. So a legal obligation comes from contracts or law. For example, a company sells lawnmower with a 1-year warranty. The sale has already happened. The warranty agreement creates a legal obligation. If customer experiences defect, the company must repair them. Therefore, the company has a present legal obligation. The second is the constructive obligation. So a constructive obligation is not written in a contract. Instead, it arises from the company's past action and behavior. For example, a company sells lawn mowers without offering a written warranty. However, for the last 20 years, whenever customer experiences problem, the company repaired the products free of charge. Customers now expect this service. Although there is no legal contract, the company's behavior has created a constructive obligation. Therefore, provisions may still be required. Okay, the second condition is probable outflow. The second condition is probability. IAS 37 generally considers probable as more than 50% likely to occur. In simple words, it is more likely than not that the company will need to sacrifice economic benefits, usually cash, to settle the obligation. If payment is unlikely, so we cannot recognize the provision. The third condition is reliable estimate. So the company must be able to estimate the amount reasonably. The estimate does not need to be perfect. Management simply needs enough information to make a reliable estimate. If the amount cannot be estimated with reasonable reliability, then a provision cannot be recognized. Okay, here's the exam tip. So I always ask these three questions. Is there a present obligation? Second is outflow probable? Third, can I make a reliable estimate? If all three answers are yes, then you guys can recognize it as a provision. Okay, next moving on to the measurement of provisions. Once we decide to recognize a provision, the next question is, how much should be recorded? So as IAS 37 says, the amount recognized should be the best estimate of the expenditure required to settle the obligation. The estimate is based on, first is management judgment, historical experience, similar transactions, and last is available evidence. The goal is to estimate the most realistic amount. Okay, let's take a look in here. Expected value approach. So for large populations such as warranty claims, IAS 37 recommends using the expected value method. Look at this example. A company sells 1,000 laptops. Past experience shows 80% need no repair, 15% need minor repair costing at $100, 5% need major repair costing for $500. So the expected cost per laptop is you guys can multiply by the 80% times the 0, resulting in $0, and then 15% times with the $100, and then 5% times with the $500. After you guys get the number, you guys can total it up and get the $40. So the total provisions is 1,000 times with the $40. So once you guys get that, therefore the company records a warranty provisions of $40,000. This is a very common ACCA exam technique. Okay, next is accounting entries for provisions. So let's look at the journal entry in here. So assume a warranty provisions is $100,000. So the debit is of course the warranty expense, and then the credit is provisions for warranty. The expense appears in the profit or loss, and the provision appears as a liability in the statements of financial positions. Okay, now let's take a look at the double entry for provisions. Remember, a provision represents a future expense for the businesses, a future liability that the business expects to pay. Therefore, when we create a provision, we record debit in expense, credit in provisions. For example, if a company estimates warranty cost of $100,000, then the debit is the warranty expense, the credit is provisions for warranty. Why? So we debit expense because warranty repairs are cost of making sales. We credit provisions because the company now has a future obligation. If the provision needs to increase, we use the same entry, which is the debit is expense, credit is provision. If the provision needs to decrease, we reserve the entry. So the debit is provision, the credit is expense. An easy way to remember this is more provisions, more expense. Less provision means less expense. Okay, if you guys already understood this, let's move on to the disclosure requirements for provision. So as you guys can see in here, even though provisions are recognized, disclosure are still required. So companies must disclose opening balance, additional provisions recognized, amounts used during the year, unused amounts reserved, and closing balance. But the companies should also explain about the nature of the provision, expected timing of settlement, key uncertainties, expected reimbursements. Okay, now is contingent liabilities. So let's discuss about this. A contingent liability is an uncertain liability that does not meet the criteria for recognition as a provision. If IAS 37 defines it as a possible obligation arising from past events whose existence depends on future uncertain events outside the entity control. So take a look in this example. Suppose a company is being sued. If it lost the case, it must pay damages. If it wins, it pays nothing. The court decision is outside the company's control. Therefore, this is a contingent liability. So why is this not a provision? A contingent liability exists because either of the outflow is not probable or the amount cannot be estimated reliably. If either conditions fail, no provision is recognized. Okay, accounting treatment of contingent liabilities. So in here, no journal entry because no liability is being recognized. Instead, we disclose it in the notes. But the disclosure shall include estimate financial effect, uncertainties involved, and possible reimbursement. Okay, now take a look in here. So, probability table for liabilities. This table is extremely important. So, probable is above 50% is recognized provision, and then the possible is 5 to 50% is contingent liability disclosure, and the remote is less than 5%, so no disclosure required. Remember, this because it frequently appears in exam. Okay, year-end timing issue. So as we can see in the scenario A, timing can change the answer completely. Assume the reporting date is 31 December. An accident occurs on the 20th December. The event happened before year-end. The obligation existed at year-end, therefore assess for a provision. In the scenario B, an accident occurs on the 10th January. The event happened after the year-end. The obligation did not exist at the year-end, therefore it cannot be recognized as provision at 31 December. This is also a common ACCA exam trap. Okay, now we're moving on to the contingent asset. So what is a contingent asset? A contingent asset is a possible asset arising from the past events. Its existence depends on the future uncertain events outside the company control. As we can see in here, the example is suppose our company sues a supplier. If we win, we will receive compensation. If we lose, we receive nothing. At this stage, receiving money is uncertain. Therefore, this is a contingent asset. So, accounting treatment of contingent asset. IAS 37 is conservative. Companies should not recognize gains too early. Therefore, contingent assets are generally not recognized. If inflow is probable, disclose in notes. If inflow becomes virtually certain, we recognize the asset. At that point, it is no longer contingent. Next is probability table for asset. Virtually certain is above 90%, so it is recognized asset, and the probable is above 50%. It is disclosed contingent asset, and possible or remote is no action required. Okay, now the decision tree. So provisions or contingent liability. So when answering any IAS 37 question, use this process. Question number 1. Is there a present obligation from a past event? If no, consider contingent liability assessment. If yes, then go to the question number 2, which is outflow probable? If no, then contingent liability. If yes, then go to the question number 3, which is can a reliable estimate be made? If no, it is a contingent liability. If yes, then it's a provision. This decision tree can solve most IAS 37 questions. So please pay attention more in here. Okay, now we're at the quick exam practice. Scenario 1. The court decision already made and compensation is virtually certain. So what do you guys think? The answer is what? Yes, the answer is recognized asset. Number 2 is the company guarantees a friend's bank loan, likelihood of payment is very small. So, what do you guys think if the answer is? The answer is contingent liability. Good job. Okay, let's moving on to the scenario 3. The lawsuit with 80% chance of losing. So, what do you guys think this is? The answer is provisions. Good. Now, keeping up the scenario number 4, company is suing supplier with 60% chance of winning. The answer is yes, the answer is contingent asset disclosure. Okay, good job guys. And finally, we get into the summary. So, before we end this lesson, let's quickly summarize the key points of IAS 37. First, a provision is a liability with uncertain timing or amount. A provision is recognized only when all 3 conditions are met, which is the present obligation, outflow of economic benefits is probable, more than 50% likely, and reliable estimate. Remember the shortcut POR. And don't forget about the journal entry as well. Also, the contingent liability is a possible obligation that does not meet the criteria for a provision. So it is not recognized in the financial statements, but it is usually disclosed in the notes. And finally, a contingent asset is a possible asset that depends on a future uncertain event. So the most important exam technique is to ask yourself, is there a present obligation? Is the outflow probable? Can a reliable estimate be made? If the answer to all 3 is yes, it is a provision. If not, consider whether it is a contingent liability or a contingent asset. If you remember the PRR rule and the probability table, you'll be able to answer most IAS 37 questions confidently. Okay, thank you for watching, and I hope these lessons help you understand provisions, contingent liabilities, and contingent asset more clearly. See you in the next tutorial.